lot of traders are going to identify their trading opportunity only after a big move has finished. But there is a subtle sign that often comes before these major volatility shifts. And we call it an SMA compression. And this occurs when 3, 4, or even 5 moving averages converge into relatively a single narrow band. And that's going to indicate a state of equilibrium. And when this equilibrium breaks, the subsequent price action is typically decisive and swift. And when you look at retail sentiment and traders, they often focus on lagging signals like moving average crosses. And by the time these events happen, significant capital has already been positioned, significant moves have already happened. But compression is a subtle quantitative signal. And during these periods, volume generally subsides and the entire moving average ribbon consolidates. Now, to the untrained eye, it just says that, hey, there's nothing going on here. But to those that know, it represents a potential entry point. Institutions use these lower volatility pockets to build their positions without impacting their price a whole lot. And markets, they cycle between periods of expansion, periods of contraction, following a significant trend. Profit taking and consolidations cause volatility to decline and price to enter a sideways range. So each simple moving average is going to reflect a different period of price, a different period of time. So when these SMAs converge, it shows that volatility is reaching a statistically unsustainable low, and it makes a reversion to higher volatility probable. Statistical analysis, this suggests that after this compression, a significant price moves become a lot more probable. And your objective as a trader is to identify the initial breakout and then position for a subsequent trend. So before we get into that, I just want to say there's a lot of nuances that you're going to pick up as you test over hundreds of charts. Okay, you're not going to learn it all in a video. But also remember that moving averages are lagging, and they're going to give you a general area of compression, right? We're going to cover that in a second, but I just want you to use common sense when you're drawing the box. So I just want you to start with a clean chart. And I want you to apply these averages, a 10, a 20, a 50, 100, and a 200. Keep them SMA. Now, the core compression, or the coil, we'll call it, it's confirmed when the range between the highest and the lowest selected moving average is less than the average true range measured over 20 periods, right? So we're looking at a volatility compression. This metric signals that the averages have converged into a tight band. We quantified it, and it suggests a low volatility equilibrium phase. And when this coil condition is met, the indicator here, it highlights the compression zone directly on your chart with a subtle green background. It's going to help you visually identify potential setups before the volatility expands. While setting up your moving average ribbon, selecting and pairing the averages can improve the quality of your analysis. So we're going to group them into short-term and long-term categories. So short-term averages are going to be the 10, the 20, the 50. And these are going to react more quickly to price changes. It's going to capture recent momentum, and it's going to help spot potential entries or exits earlier, right? The tight compression among short-term averages often signals an imminent quick move or a volatility expansion in the near future. If we look at the longer-term averages, the 100 and the 200 period, this is going to show the overall trend landscape. It's going to filter out noise, and it's going to highlight significant market phases, right? Compression within a long-term average. And this can signal a sustained consolidation, a longer consolidation that can precede huge directional moves. And we're going to use a confirmation filter. And the compression indicates that a significant move is probable. We don't know when, but we know something is going to happen. And it also does not define the direction. Now, generally, when price moves into a consolidation phase, it breaks out into the same direction it entered. So to gauge the strength of the eventual breakout, we're going to use the ADX. So when the ADX starts to rise and then go above 20, it's going to signal that the trend strength is increasing. And when you backtest, you're going to see that trades taken when it's rising do tend to have a higher win rate and overall profitability. So here we go, the playbook. First, you want to identify the point of compression. Draw a consolidation box around the highest high and the lowest low of the last 10 bars, right? You must use some discretion here. Wait for a candlestick to close outside the box and enter on the first pullback to the exterior of the box. Your stop loss, you don't want to place it on the opposite side of the consolidation box because those are often targeted, so just put it on the opposite side of the moving average ribbon. The initial price target is the height of the box multiplied by 1.5, and that's projected in the direction of the breakout. Now, if you are more conservative, just aim for a risk-reward ratio of 1 to 1.25. So for every dollar you risk, you're looking to make $1.25. If the price trend continues, trail the stop with one of the moving averages. Allow your profitable trades to run as you get more experience, but you certainly do not want to give back more than 50% of the open profit. Let's look at a few examples. This is a chart of Bank of America. And listen, I chose less than perfect example. And this has a compression of the shorter term averages, the 10, the 20, the 50. The ADX, it's below 20. It shows a weaker trend. And once price breaks out, this chart gives a pullback. Enter on the break of the pullback candle. Stop goes under the averages and your profit target is set at 1.5. I also want you to notice that the ADX is rising and it's going above 20 level. That just shows an increase in trend strength. Looking at forex, we're going to look at the euro yen. We're going to use all the moving averages for this one. And I do find that currencies tend to be decent trending instruments, and moves from consolidations like this can run a long way. So here we have the consolidation. We have the breakout that eventually pulls back deeply into the consolidation. That happens. But price does it again, breaks out, and it holds. Now you have to understand that pullbacks can appear in a lot of different forms. And here, this candle would be a pullback on a smaller time frame. But regardless, it's a lower volatility candle. We see a rising ADX giving support to continued upside. Enter on a break above, stop goes below the average. Profit target is 1.5 times the size of the box. Now, no strategy is perfect, right? Failed breakouts occur. But warning signs include volume stays low. You see a flat ADX reading for many bars. Or you're going to see price return deep inside the ribbon within a few candles. In this case, exit your position, reevaluate. Managing losses and doing that effectively, it's critical to preserving your capital for higher probability trend opportunities. And you want to keep your risk low until you have the experience to handle larger positions. And let's say you're going to use 1% risk and your account size is $25,000. Well, your maximum loss is going to be $250. So let's pretend we're looking at stocks. Your risk is $2 per share. That's the difference between the entry price and the stop loss. And there's your position sizing. So you have homework now. And this week, I want you to open up TradingView, and I want you to scan the S&P 500 daily charts. Right? Look at all the stocks in the S&P 500. Identify 3 stocks where the 10, the 20, the 50, the 100, 200, a combination of those are trading within 1 ATR. I want you to add these symbols to a watch list, include the ADX indicator, and paper trade the first closes and pullback outside the ribbon. I want you to log the results and repeat this process until you have 10, 20, 30 examples. And then, only then, should you consider even thinking about risking live capital. Mastery of anything is achieved through repetition and reflection of what you did. And I'm going to repeat this again. The nuances to this, just like they are in trading overall, they're numerous. And you need to study the successful trades, what they have in common, as well as the ones that fail. Your weekly routine on a Sunday evening, scan the daily charts for compression setups in any market that you want and put these tickers into a spreadsheet. And check these charts every single day or set alerts. And on Friday, review any trades that you may have placed in your paper account. Export the journal and learn from that. Market conditions are going to evolve, but the mechanics of volatility contraction and expansion have remained constant since trading even started. So the key takeaway here is that when multiple simple moving averages consolidate, the market is almost storing energy for the next move. So a disciplined approach involves waiting for a confirmed breakout with a rising ADX, enter on a pullback, and manage your risk. And by doing that, you're going to be shifting from chasing a price move to anticipating them and waiting to take action. And if you like this video, I want you to hit like, subscribe to our channel, and we'll talk to you soon.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.